Good afternoon to our CLA family members, our clients, community partners, and friends. Welcome back to our live stream. We sincerely hope that all of you are staying safe and healthy at this time. Today's going to be an amazing lineup. We had some legislation moving through Congress, and we want to bring you timely updates on how they can impact you and your organizations. To kick things off, we have Austin Bennett, a principal out of our Milwaukee, Wisconsin office, here to talk about what we're seeing with the crypto in the infrastructure package. We then have Andrew Zebell, a manager out of our St. Louis, Missouri office, to discuss the energy-related proposals in the infrastructure package. And finally, we are thrilled to bring back Jen Rohen to give us timely updates and IRS guidance that has been provided related to the employee retention credit. Welcome, team. Welcome, Austin, Andrew, and Jen.
It's good to be here.
With you.
Awesome. Yeah, before we dive in today, we have some housekeeping to cover. We have the ability for a live Q&A during our session today. In order to participate, you must register and log in using the link below me. The questions will appear for you in the audience to see and like and move up in priority so that we can address them. We have moderators standing by ready to engage and interact with you. As a future shout out, we want to invite you to a special event on August 31st called Data Security for Nonprofits in Remote Workplace. You can register for this event on our website. In addition to webinars, be on the lookout for articles and other white papers providing additional guidance. And as always, call your CLA relationship. We want to talk to you. We want to hear from you. Before we begin, please go ahead and smash our YouTube like button. We want to make sure that these resources can be shared with other YouTubers as well so that they can also benefit from this guidance. All right, okie dokie, Austin, let's kick this off. Let's jump right into it. What can you tell us about the cryptocurrency proposals in the infrastructure bill?
Well, thanks, Matthew, and good to be with you today. So, crypto has been quite the hot topic over the last few weeks as the Senate underwent negotiations on its bipartisan infrastructure package, which was ultimately passed by the Senate on Tuesday. And included in the bill was a provision that calls for increased regulation and tax reporting requirements with respect to cryptocurrency transactions, which is generally effective after 2023. The Joint Committee on Taxation is estimating that this crypto provision is going to raise approximately $28 billion in tax revenue over the next 10 years. However, the provision was met with a great concern from the crypto community, which for years has more or less kind of operated as the Wild West, in particular, from a tax reporting standpoint. And leaders and lobbyists within the crypto community pushed really hard for the Senate to scale back the reach of the Senate bill. And in the days leading up to Tuesday, when the bill was passed through the Senate, there were competing amendments proposed by a bipartisan group of senators who collaborated with the Treasury Department, namely Democratic Senators Mark Warner and Kirsten Sinema, along with Republican Senators Pat Toomey, Rob Portman, and Cynthia Lummis, that would have taken a lot of the teeth, if you will, out of the crypto-related portions of the bill. The big concern, with the bill amongst the crypto community relates to the issue of who exactly is subject to these new tax reporting requirements that are contained within it. The bill broadly defines brokers as subject to these reporting requirements, which seems to include, crypto miners, software developers, and various actors that serve as validators of cryptocurrency transactions. The bill is indicating that these brokers who help maintain the integrity of the cryptocurrency environment would be required to report transactions to the IRS and their customers on a 1099. And so critics of the bill are arguing that this casts too wide of a net and that many groups will fall into this reporting requirement despite not having the access to the necessary information to properly comply with the requirements, as there's just a significant degree of anonymity that's inherent in the crypto market. So it's tough to get that information. So much of the lobbying efforts, within the last couple of weeks surrounded these attempts at scaling back and clarifying who is considered a broker and subject to these new reporting requirements. However, at the end of the day, these last minute efforts to pass any amendment associated with that bill ultimately failed before it was passed in the Senate.
Awesome. That's great info. I think it's very interesting to see how this is all coming together and it's beginning to evolve. So what's next with this Senate bill and where do you see things going from here?
Yeah, so the Senate bill now moves to the House of Representatives this fall, and we certainly are expecting, significant lobbying efforts to continue from the crypto community to urge the House to pursue amendments, similar to what was proposed during the Senate process. However, we don't know at this point whether the House will even pursue any of those amendments to the Senate bill, let alone the crypto-related components that were brought forth by the group of senators that I just mentioned, or if these types of issues are going to need to be addressed as part of subsequent legislation in Washington. On top of that, we're also going to have to keep a close eye on how Treasury, ultimately reacts to this and begins drafting the corresponding regulations once the final bill becomes law. So the bottom line here, Matthew, is that we are still in the middle of the game here with crypto. So we'll just need to kind of wait and see how the process, plays out in Washington.
Yeah, patience has been something that we've always been, following for the last year. So I'm sure that there's going to be a significant amount of negotiations and patience that needs to be had that'll take place as we move forward, given the tax impact and the stake for a market that I think you and I connected earlier on that has over $2 trillion in cap. So, it's going to be an interesting time. Now, I imagine that there's going to be a lot of concern about how this bill would really shape the landscape for the crypto market, even beyond the tax reporting and compliance aspect of things. Can you talk to that?
Yeah, absolutely. So my sense is that people within the crypto community in general understand and kind of appreciate the fact that there needs to be some structure surrounding the tax reporting and compliance aspect of crypto. So as this has been, it's been coming down the pike for a few years now, and we've seen, starting with the 2019 Form 1040s, the IRS started asking questions about if taxpayers had, reportable virtual currency transactions. So, we've been seeing this type of thing coming. So I don't think the tax enforcement angle to the bill is necessarily surprising to most folks, but I think the overarching concern relates not only to the perceived overreach of the Senate bill, as I mentioned, but do these new laws and regulations, did they stifle innovation within the crypto space? Will we start to see certain jobs go overseas as Congress and Treasury begins to put this all together? On top of which it's just a very complicated space that many Americans, quite frankly, as well as congressmen and women, just don't fully understand. So I think that may kind of continue to cause for a little bit of a bumpy ride from a legislative and regulatory perspective as we move forward here.
Yeah, thank you, Austin. For those listening to this webcast today, what do you think are some of the key takeaways from the Senate bill that was passed on Tuesday?
Well, certainly if you are an investor of cryptocurrency, I wouldn't panic just yet. As like I said, there will likely be more to this story that will unfold over the coming months. But at the end of the day, just understand that we are moving towards a more regulated environment from a tax reporting perspective. So if you are holding digital assets, you really want to get ahead of this and start wrapping your mind around your holdings and whether you have properly reported activity in previous tax returns. As from a tax reporting perspective, cryptocurrency is considered a capital asset, no different than a stock or a mutual fund. And when you sell it, exchange it, or even perhaps use it to make those everyday purchases like a cup of coffee, you have a taxable event that needs to be reported on your tax return. Thankfully, there are many apps that are out there in the market that can provide you with good gain loss reports to help you or your tax preparer, from a compliance standpoint. However, it certainly would be prudent if you haven't necessarily been fully compliant with respect to, capturing your cryptocurrency transactions on your tax returns to go back and review that activity, assess any exposure you may have, and potentially amend your returns, to pick up those unreported capital transactions. Alternatively, given the market volatility of crypto over the years, it's certainly conceivable that many taxpayers may have unreported capital losses with their crypto transactions, which of course, would provide for immediate tax savings opportunities. So you just want to engage with your CLA tax professional if you have questions or concerns regarding crypto holdings and your tax reporting requirements so that, you can be as prepared as possible once implementation of this new bill ultimately becomes law and the reporting requirements begin.
Yeah, thank you, Austin. That was really great information. And I will say, the crypto market, it's extremely intriguing. It's a little confusing, it's a little scary, but I look forward to future updates. So please stick around for any follow-up questions that we might have towards the end of this live stream. Let's now pivot over to Andrew. Andrew, you're up. What can you tell us about some of the energy proposals within the infrastructure bill?
Thanks, Matt. Yeah, this is an extremely exciting opportunity for those involved in clean energy and really anybody that's just generally concerned about climate change. Before diving into the details of the legislation, I just want to explain the flow of the infrastructure bill. So the infrastructure bill is broken down into 7 divisions, and these divisions dive into several categories such as energy, broadband, transit, water, sewer, road, and bridges. So it's approximately 2,700 pages, a lot to unpack in this legislation that was just passed by the Senate. However, I'm not going to dive into the entire bill. It'll take probably days, hours, but I will focus on Division D, which is the energy section of the infrastructure bill. However, don't let the title of energy mislead you. This section impacts multiple industries: construction, real estate, nonprofit, school districts, M&D, not just energy. So, and I'll explain those a little bit further. But just taking a step back, the overall goal of this legislation by Congress is to reduce future greenhouse gas emissions and to reduce the negative impact of climate change we're already experiencing, such as there's a section that specifically as relates to wildfire mitigation. So the last I checked, and I'm sure this is going to change, the energy portion of the infrastructure bill is about $73 billion of the total allocation. This legislation aims to generate investments in green energy and green energy products and services through grants and loans. So diving into the energy portion, so those affecting our clients that generate energy, that transmit or distribute energy, or even those that provide natural resources and raw materials used in the energy creation process. So there's grants, research and development grants specific to hydrogen. That's about $10 billion. There's nuclear energy, which I think is particularly exciting because nuclear energy has seen a lot of ups and downs and financial struggles. There's been talks from a lot of utilities about closing down their nuclear facilities. Congress clearly has identified this as an issue, and they've gone to the extent providing tax credits and incentives to keeping those nuclear plants open. In addition to that, there's research and development grants associated with microreactors and smaller reactors they can basically use to start up a nuclear reactor or nuclear facility in rural areas. In addition to that, there's separate grants and programs for hydro, wind, and geothermal energy. Now, moving on to our transmitters and distributors, there's a section that's very long in the infrastructure bill called grid infrastructure. This portion of the bill focuses heavily on the transmission and distribution. And so transmission is the long-term movement of energy over, when you're driving down the highway, you'll see transmission lines, power lines. Distribution is taking it from the power grid, your local power grid, to the homes. So under this section of the bill, there are various grants available for improving our transmission and distribution lines. The importance of getting our transmission infrastructure right is so we can take energy from places that have a lot of sun or a lot of wind and moving that energy to places that don't have as much clean energy ability. So there's grants and opportunities out there that are going to get passed to local utilities and any entity that's involved in the transmission of energy. As well, there's also some storage opportunities and research and development grants as it's related to that. Moving on to some of the green products and services, there's research and development grants for carbon capture, utilization, storage, and transportation. For those not familiar with carbon capture, that's essentially taking CO2 out of the Earth's atmosphere and shoving into the core's Earth. So a lot of organizations will be interested in some of these carbon capture, specifically higher education and research and development organizations. Energy efficiency and building infrastructure. So this is where we're going to break down and where the portion of the legislation moves beyond just energy. So there's a section as it's related to residential and commercial energy efficiency. And This funding provides investments for heating, lighting, windows, really appliances that goes into commercial and residential properties. There's another pretty exciting piece of this legislation that dives into buildings. So this focuses on, remodeling existing buildings, making them green, and also new construction and making that green. So, individual recipients, as I read through this legislation, can receive up to $2 million. And then moving on to the third section here, there's a section as it relates to industry-specific energy efficiency. Really what this means is that the federal government's going to give up to $2 million to manufacturing distribution companies to invest in smart manufacturing. So smart manufacturing meaning robotics, artificial intelligence, with the emphasis of decreasing energy usage. So I think most every manufacturing entity in the United States has some involvement or is considering the use of artificial intelligence in manufacturing process. This might be an opportunity for you to get some capital to help fund those initial startup costs. And then this last piece of an organization that I was quite frankly surprised even got a shout out in the energy section here is schools and nonprofit organizations. So there's grants for schools and nonprofits to purchase green products, for example, electric cars, and other energy usage reduction measures that they can use in their schools. So, it's very interesting. I was surprised at how much of this portion of the legislation wasn't specified directly to energy entities, and really moved on to try to understand how we can reduce our usage and how we can provide green products to all sorts of industries. The other thing that the final thought here is throughout the bill, there's an emphasis on providing funding to smaller organizations in rural areas. So there's something else to keep in mind, that you do not need to be a large organization to receive funding.
Yeah, I think that's a key note there, that it's not just earmarked towards large organizations. There is some earmarking towards the smaller, closely held businesses, which is really refreshing to hear. Yeah. Let me ask you a question. Just kind of off the top here, how is funding going to flow to the eligible entities?
That's a good question. Some of the funding is probably going to flow from the federal government, for example, the Department of Energy, directly to those recipients. But as you read through the legislation, a large portion of it is going to pass through state and local governments. And then state and local governments will then distribute those funds to the ultimate recipients based upon their eligibility. And that eligibility is determined based upon the legislation. So, this is important for the state and local governments because they have received a lot of federal funding. They're administering a lot of that. And fortunately, I think for the citizens, there's going to be more of that. I think, unfortunately, for the state and local governments, they're going to have more work to do.
Thank you. Oh, sorry about that. Yeah, one more follow-up for you there, Andrew. Mm-hmm. What should clients, prospect, what should they pay attention to? Any prospects concerning these credits and these opportunities? What should they pay attention to if they believe that they would be eligible? Maybe some things that they can start doing now. Any insights?
Yeah, I would read the fine print of the infrastructure bill. I'm not saying to go through and read the entire thing, but understand, where there might be some opportunities for sustainability in your business. And then I would say talk to an expert, someone that really understands federal compliance requirements. And then, there's things you need to pay attention to. For example, some of the funding is predicated based upon matching. You need to match a portion of the grant funds that you receive. So there's some compliance requirements with all federal funding, and for-profit organizations may not be familiar with this. So just something to be aware of.
Absolutely. Thank you very much, Andrew, for the insights. Let's now pivot to ERC. So Jen, let's bring you into the conversation. Last week, we thought we shared all of the news we could about ERC, but with Notice 2021-49 and the Senate infrastructure proposal, which we've talked a little bit about already, there's some updates. So now that proposal has passed the Senate, we wanted to bring you back, Jen, for additional comments. We also need to talk a little bit about the Revenue Procedure 21-23 that the IRS issued this Tuesday related to ERC. And finally, if we even have time, can we talk about Notice 21-43 related to the Work Opportunity Tax Credit? Welcome, Jen.
Well, thank you, Matthew. It's great to see you in the host chair. As promised, I brought a little prop. I'm not sure if everybody can see this with the lighting, but it's my MRFC Matthew Rambaran fan club here for the CLA live stream. So, as promised, I'm cheering you on. You're doing a great job as host. So,
That's
thanks
awesome.
so
Thank you
much
so
for having
much.
me back.
Absolutely, that's awesome. Thank you so much. I love the acronyms. We're so used to them nowadays. So the Matt Rembrandt, club is. Thank you.
You're welcome.
All right. All right. So can you remind me a little bit about, some of the changes that occurred this week? Let's jump into it. Let's talk about the
Sure.
Senate bill.
Yeah, so I mean, first, just to, as you mentioned, so the Senate infrastructure bill was passed, at least through the Senate. The proposal was passed and turned into a bill. What that did, and this didn't change upon passage, was that it proposes to eliminate the retention credit for Q4 of this year. That's not to say it's a done deal or there's any reason to panic, as most employers at this point aren't even certain that they'd qualify in Q4 anyway. But to the extent that there is planning to be done in Q3 to qualify for that final quarter, and you think that this is going to be passed eventually through the House and made law, my best advice is always to say that it's wise to follow the business decision rather than to let the incentives prioritize the overall tax strategy. So that's something to keep in mind as it relates to just what's going on in there.
Yeah, that makes sense. Are there any situations in the Senate bill where employers could still qualify for that credit?
Yeah, absolutely. So as you might have recalled, the American Rescue Plan does allow for the creation of a broader definition of eligible employer. One being a severely distressed employer, and then the other is these recovery startup businesses. So what the Senate bill says is that even though overall the employee retention credit would be eliminated in Q4, it would still be in play for those recovery startup businesses.
Okay. Thank you. Thank you. Last week, and kind of refreshing what happened last week, right? We had Omar on the conversation, and he raised some questions about the House not being in session and the bill ultimately not being able to be finalized and signed until the fourth quarter of this year. Now, do you have any thoughts on that and its impact on the ERC?
Yeah, so that's a possibility. And in that event, we've got a lot of options. First of all, it's possible nothing would be passed and signed until Q4 and the elimination of the credit would be impossible. It's also possible that there would be some construction or language in the law that would still eliminate the credit for Q4, even when signed after September 30th. So this is one real area where we're going to have to wait and see what's in, what the House comes back with and everything that comes into play and how ultimately the language, assuming anything gets signed, of the law is worded.
Yeah, those are good points. Yeah, let's stay out of the gray areas. I feel like a world we've been living in for the last year with all of these programs. Let's focus our time now on some of those procedures. So let's start with the notice 2021-49, which you touched on last week. Give us an update on that.
Sure. That's a great idea. We can put our crystal balls away and go back to what we actually do know. So remember, essentially Notice 2149 gave us some good intel related to the rescue plan and the expanded definition of an eligible employer. It also clarified that we can take the TIP credit in connection with the employee retention credit, so it did broaden the applicability. And finally, it answered the two pressing questions about ownership attribution rules and then the timing of the adjustments to income when claiming the credit.
Let's focus in on that ownership matter. Let's talk about it. What are those attribution rules there?
Sure. So with the ownership issue, the important considerations are that if an owner has greater than 50% interest in the business, their wages are not eligible for the credit. So ownership is going to be determined either individually or by attribution rules. What this means is that if an owner is related to other individuals in the business, we have to consider their percentages of ownership when evaluating eligibility of wages for the credit. Initially, it was unclear to some whether spousal ownership was included in the attribution rules. So the notice clarified that spousal ownership must be contemplated for purposes of evaluating whether wages are eligible for the credit. I'll give you an example to help. If you had two individuals who are unrelated equal owners in a business, both of their wages would be eligible for the credit. However, if those same two people are married to one another, then the attribution rules would kick in. Each would be deemed 100% owners, and therefore their wages would be ineligible for the credit. So it's an important distinction.
Yeah, I think that definitely helps clarify the rule on the attribution testing there. What other key points or clarifications in the notice related to wage expense adjustments?
Sure. So, as you might know, all of these tax credits that are based on wages require the taxpayer to adjust the wage expense by the credit amount because you can't take a credit and a deduction for the same amount on your tax return. So, when we engaged on this legislative journey with the retention credit, many organizations were not eligible to consider the 2020 credit until the Consolidated Appropriations Act was signed at the end of 2020. So what that did was it required eligible organizations to file an amended 941X return in 2021 for the 2020 credit. So it begged the question for anyone who did not extend their return, and for businesses who are not timely filing their returns, to say which tax year is going to be the required year to make that adjustment to the wage expense to add back the credit amount. The notice clarified, to the disappointment of many who did not take the extend as your friend advice from our friend Leslie Boyd, that if you file the amended 941X to claim the credit based on 2020 wages, that you're going to have to adjust the 2020 wage expense to reflect the credit, even if it means amending your tax return. It goes on to say that, like, if in later years you claim the 2021 credit and file an amended 941 to do so, you'd actually have to adjust your 2021 wage expense as well.
Yeah, no, extend as your friend is something that Leslie has, like, she said it numerous times. So it is a little frustrating, but yes, absolutely. If you extended, there's definitely some opportunity to fix and correct. Do you have any guidance for people now as they begin to file their extended returns?
Sure. So, Matthew, I know many people are still waiting to file those 941Xs until they get more clarity around eligibility for the credit. And in many cases, the same people are getting more comfort thanks to the RevProc that we'll talk about next. So, if you believe that you qualify and you have the credit amount completed, go ahead, and if you know the amount, reduce that wage expense on your 2020 return, even if you haven't pushed through the paperwork for the 941X. But know that you're going to do so. That can save you some heartache later and won't stress your teams from a filing perspective.
Thank you. Now, we mentioned 21-23, Rev Proc 2123. There's a lot of these out there, but that came out this week, right? So, what is that revenue procedure and how is that notice different than what we've seen?
Sure. So lots of number soup, right? As you're talking through these various notices and the RevProc, but it's a great intro question before we even unpack what's in it, trying to understand the difference. So, as you know, we're always looking for binding legal authority. We get letters and FAQs that give us guidance and notices that indicate what the regulations may ultimately say. The notices are going to be recorded in the Federal Register, so they're a bit more binding than the webpage FAQs. Now, revenue procedure is going to be an official statement of a procedure published in the bulletin that either affects the rights and duties of the taxpayer or other members of the public under the Internal Revenue Code and related statutes and treaties, or although not necessarily affecting the rights and duties of the public, should be a matter of public knowledge. So I guess what I'm saying is that a RevProc is definitely more authoritative than a notice. So the fact that we have a RevProc amplifying what's in the notices and giving some clarity should give taxpayers a little bit more comfort when claiming that credit, that we've got that guidance and it's just a little bit more formalized.
Yeah, thank you for that insight and a little bit of understanding behind the differences between the two. As my lights go out.
Oh, no.
I lost my train of thought there. So what was in this week's RevProc that's got everyone talking? Like, what's the buzz? Like, what's really?
Yeah.
Let's get to it.
Well, it's exciting. It truly is exciting. So RevProc 2123 amplified and reinforced all three of the ERC notices issued this year. And so just for refresh purposes, those were 2120, 2123, and now as of last week, 2149. What further did was created this major impact by clarifying the gross receipts as it relates to not all, but several of the economic relief programs. Remember, Matthews, that one of the ways an organization can be eligible for the retention credit is if they meet the significant decline in gross receipts test. When we look at gross receipts from a taxable or tax exempt side, for purposes of the tax return, we know that we have to include the economic relief programs in that definition and reporting. What the IRS did in the RevProc was to acknowledge that including the economic relief dollars in gross receipts for purposes of the eligibility test would create a circular problem of eligibility for the employee retention credit. Never mind a timing nightmare of what quarter to report the forgiveness and the funding and how to do that overall on your financial statements. So the RevProc officially creates a safe harbor, allowing organizations to exclude PPP forgiveness, shuttered venue grants, and the restaurant revitalization funds from the ERC gross receipts test. This is a huge, huge, huge relief to many organizations who are hoping to qualify for the credit and were kind of biding their time waiting to see what would happen because they didn't know what to do with all of these other economic relief grants and programs. So the one thing it does say is that the safe harbor must be applied consistently to all programs in order to be valid, and the record keeping requirements do remain intact. It also does not remove the requirement for tax purposes of including all of these programs in gross receipts.
That's great news. I expect a lot of our clients and other organizations who may have been holding back on claiming the ERTC credits, I think they're going to need to consider reevaluating their eligibility with some comfort now that we've clarified, some of the gray area, some of that, some of the confusion.
Yeah, absolutely. I completely agree. I mean, the more we hear from the IRS, the more comfortable organizations are finding themselves related to their eligibility for the credit. This is one of those credits for which we have a lot of time to file our claim for refund, but it's also one where the IRS has a lot of time to come back and take a look and audit it. So wise decision makers are really taking their time and also making sure to have as much contemporaneous documentation as possible in place relative to eligibility prior to filing their claim.
Absolutely. Thank you. Thank you. Can you tell us about any other happenings with the IRS?
Yes. So I'm going to be quick here because I know we're running up on time, but we do have the work opportunity tax credit, which remains in place. And this week, the IRS issued another notice 2142, related to employers who have received denials for new hires starting January 1st of this year through October of this year, and who fall into the category of the designated community resident because they're an empowerment zone resident, or if they're a qualified summer youth employee. Similar to the big notice that allowed us that look back at the beginning of the year, you may recall those live streams where we were telling everybody they could look back. The notice allows for employers who have received denials for these applications for certification the ability to resubmit them without any regard to the normal 28-day deadline. So they must have a denial in hand in order to resubmit that claim. So it's less of an opportunity, I think, as the original notice 2078 that we dealt with in December and January. But it's definitely worth mentioning here to any employers who are going their own with the WOTC credit and have denials for those federal empowerment zone residents in hand.
Thanks, Jen. And you're right. I think it's important that our clients continue to pay attention to the guidance, pay attention to these long-term credits like the WOTC as we enter, our recovery phase and see, some of the economic relief programs coming to an end. Do you have any other comments on WOTC, before we jump to the chat box or?
Yeah, only this. Typically we've seen about 10 to 15% of any organization's new hires qualifying for WOTC. Because of the updated federal empowerment zone rules, as well as this category that allows for hiring long-term unemployment recipients, meaning someone who is unemployed for a period of 6 months at the time they come to work for the employer and at some point received aid. This year, we're seeing an unprecedented rises in the average of up to 20 to 25% of employees being eligible for the credit. So if you've held off on pursuing WOTC in the past, now might be the perfect time to revisit that decision and move forward.
Thank you, Jen. Let's move now to some questions that are coming through our chat box. So Austin, I'm going to put you on the spot on this one. And I'm not sure if you can answer this question to its fullest because we still are waiting some guidance here, but let's give it a try. Now, one of the questions that came through, are you finding that employers are starting to offer to pay bonuses to employees and contractors using crypto?
I mean, Matthew, I personally have not seen it in my practice, but I would imagine as we kind of move forward here and this legislation, gets more formalized, I could potentially see that happening. And two things I would note related to somebody doing that or a business doing that is, as I mentioned at the front end, most crypto transactions are going to be treated as capital gain type transactions. But keep in mind, if you are receiving, compensation in the form of cryptocurrency, that's going to be treated like ordinary income, just like any other wage paid to you would be. And so the other point on that too is, the withholdings, your federal income tax, state income tax, Social Security, Medicare, all those payroll taxes, those would need to be paid in cash. And so the entire form of that bonus compensation piece would have to be kind of split between cryptocurrency and US dollars.
Gotcha. Now, one thing to ask, and I know you and I were having a sidebar conversation earlier, do you foresee anything with cryptos being recategorized or treated as, other than an asset that could impact taxes, or is that something to even consider at this point in time?
At this point, I think we just need to wait and see what happens with this bill and go from there. But at this point, I don't see anything changing it from it's traditionally categorized as a capital asset at this point in time.
Okay. Unfortunately, folks, that's all the time we have for today. Thank you to our speakers, Austin, Andrew, Jen, as always. Thank you for coming in and presenting these technical insights. Please make sure to register and engage with us. We love having you be part of our conversation. We will see you on August 19th. And until then, stay safe and healthy. Take care.